Coming up today, stocks edge higher, going into Nvidia earnings tomorrow, Wall Street's last bear, a look at fast food prices, uranium trading higher, why Ethereum is ripping higher, and Robert Kennedy joins the apes in GameStop. Hey, what's up guys? Welcome to the Daily Market Review. My name's Jared. Thanks very much for tuning in with me today. And this market is sitting pretty going into Nvidia earnings tomorrow. Ever since Powell and Yellen came out on the first of the month, gave strong indications to the market. We've been nothing but up and to the right. Not even a 0.5% pullback, and here we are sitting pretty much at all-time highs, 53.21 in the S&P 500. And just looking at the S&P 500 ETF SPY, actually the lowest volume day we've had in years for a non-holiday trading day. And I'd say that's due to a couple of reasons. Markets just drifting high on really low volatility, and typically big volume days are associated with selling. So there's not much selling going on here, and we've also got Nvidia earnings tomorrow. And so the market may be in a little bit of a wait and see mood, as we've got the third largest stock about to come out and give us a look at their first quarter. Earnings expected to come in at $5.60 a share, and I'd say the all-around expectations is that they're going to beat on that, maybe by 10% or so, and they may come in at $6.20, $6.40, something like that. But more importantly, it'll be the market's reaction. Whether we gap up to new all-time highs, that'd be above 974, currently trading at 953. And like I said yesterday, we have to trade somewhere around $1,200 a share for it to be the largest company trading on the market. And option dealers are not worried at all. Looking at VIX 1 day, priced that at 7, got the VIX 9 day at 10, and the main headline VIX 30 day at 11.8. And just going out to a monthly logarithmic chart on the VIX, so we can better visualize it. It's the lowest the VIX has been since pre-COVID, back at the start of 2020. Although it has been materially lower before. In the really quiet, grinding higher year of 2017. VIX actually got down to 8.5 and spent a lot of the year trading around a 9-10 handle. So there's still room for it to go lower. And I'd say now that we're at all-time highs, we're highly likely to come down to low 11s, maybe even hit a 10 handle. But again, I think the market's giving ample hedging opportunity, as we're bound to get a bit of a VIX spike going into the election in November, which we typically get a spike going into that. And there's basically just no one shorting this market. Short-only hedge funds have been largely washed out the last couple of years. Even long-short hedge funds have struggled, lost a lot of assets under management, pretty much been passive long-only. That's taken all the market share and just plain market beta products like S&P 500 index. See that in this chart here, total short interest as a percentage of the Russell 3000 market cap, only at 1.6%. And even though a low VIX can offer up some good hedging opportunities, looking back in history, typically the lower the VIX, the better the forward return on the S&P 500. When the VIX is under 13, on average, S&P annualized returns around 47%. Between 13 and 17, it's around 30%. 17 and 20, 15%. And when the VIX is above 20, it's typically bad for the stock market going forward. Now, here's a look at the latest odds of who's going to win the US presidential election in November. And this is taken from all online betting sites and crunched into one single number. There's Trump just below 52%, Biden just below 40%, and trailing by a long way, but still coming in third, is Robert Kennedy Jr. And you know the stock market's an interesting place when you've got the third presidential favorite coming out on X today, announcing he's just invested $24,000 into GameStop shares in support of GameStop and the apes, saying that we need a free and fair market. Let's punish predatory short selling to the moon. By the way, I ride with you and I'm not leaving. And yes, this is real. This is not AI. This is not fake news. He really did post this. And this just takes the meme stock saga and their fight against Wall Street, short sellers, Citadel, to a whole new level, as we've now got a major US politician shining a light on this issue by investing in it. However, that news didn't really get the apes too excited. GameStop finished down 4.4% today. Same with AMC, trading relatively flat there, along with the rest of the meme space, having a bit of a pullback here today. What's really in the focus this week is the number one story leading this bull market, artificial intelligence, and the number one player, Nvidia, thought of as the picks and shovels seller of the hardware that powers artificial intelligence applications. Stock's already up 91% year to date. Expectations are high going into tomorrow afternoon. Thanks to their signature product, the H100 chip. They've already got their next generation Blackwell AI chips on the way later this year. And basically the street is expecting nothing but more good things. Wells Fargo, price target 1150. Bank of America, price target 1100. Deutsche Bank a bit lower at 850. And it won't be just the numbers we're looking at. We'll be also looking for their guidance for the rest of the year, which is also expected to come in on the high end as well. And what started with a boom in Nvidia's stock price early last year, setting off the AI bull market, that's now spread out into the normally boring and sleepy, low volatile sector of utilities. Best performing sector this year. And we can see that in the daily chart of utilities. Sector fund XLU still walking the line in a strong momentum parabolic rip here. And that's because of just the huge amount of power that AI applications use, causing a surge in electricity demand, along with forward expectations of what electricity demand is going to be. And you can see that in this simple chart here. A simple ChatGPT search uses about 10 times the amount of power as a simple Google search. And that's why 3 of the top 5 best performing stocks in the S&P 500 year to date are actually utility companies: Vistra, Constellation, and NRG Energy. And those stocks have gone into absolute parabolic rips this last 6 months or so. There's Vistra, Constellation, and NRG Energy. Really strong uptrends there. And according to some like Gene Munster, he thinks the stock market bull rally could last another 5 years, but it'll end in a spectacular bursting of a bubble. And he thinks a new crop of AI companies will go public and drive a boom in the stock market. And he expects the rally to morph into a bubble that eventually bursts. I guess one could argue we're already in a bubble, even though we may not have got into that crazy late stage speculative melt up that we normally see before the bubble blows up, in which it looked like that already happened in 2021, but because we're at all-time highs, we may have not reached that crazy late stage yet. Others like Capital Economics think the market will inflate another 20% before the bubble bursts. They think the S&P will notch 6,500 before staging a correction, and they also pointed to similarities between this current AI bubble and the internet bubble of the late 90s. However, according to the chief economist from Citi, things are not looking so great. He said the US economy is headed for a hard landing this year. Deep rate cuts are the only solution. He pointed towards a gradual softening in the jobs market, said it's happening, and that tends to snowball. He's calling for 4 interest rate cuts this year, and he pointed to the hiring rate. Right now at the lowest rate it's been since 2014, and that small businesses are telling us their hiring intentions are at the lowest levels since we've seen since 2016. Sharing that view is Bond King Jeffrey Gunlock. He's still calling for a recession to come. Had previously been calling for a recession to arrive in the first half of this year. Now he's not so sure whether it'll happen this year, but still thinks it's going to come next year. And he's pointed to elevated inflation, higher interest rates, and rising rates of household debt, and pointed to some other things like a lifestyle adjustment needed for a lot of people that got used to all the money printing and stimulus post-COVID, racked up huge credit card bills, and that can't go on forever. And sitting out on the lonely island is Wall Street's last bear, JP Morgan's Marko Kolanovic, sticking by his forecast for a 20% market sell-off, calling for the S&P 500 to hit 4,200, pointing to very high equity valuations, says he does not see equities as attractive investments at the moment, said AI won't save the stock market, high interest rates eventually have to hurt, and this guy's been consistently bearish on stocks throughout 2023 and into this year, which has got to be a very tough place to try and stay. And maybe him too will join Mike Wilson from Morgan Stanley and flipping from bearish to bullish in the near future. We also heard from a Fed governor today. Christopher Waller said we need several more months of good inflation data before they can start cutting rates, and dismisses talk of a possible rate hike in a similar tone to Jay Powell. They're really not thinking about hiking rates, pretty much waiting for the first chance they get to go ahead and cut rates, and they're not too really concerned about embedded structural inflation. Could be more of a case now the United States going in a similar path to Japan. With so much debt, they just can't afford rates to stay high for too long, and we can see that in this chart here. On the monthly average, the US government spends on interest to service their debt, skyrocketing this last couple of years, now approaching $70 billion a month, and that means for the first time ever, the interest expense on debt could soon surpass that of what the state spends on defense, and that is a big reason why the government needs rates lower. However, the reality is all that structurally embedded inflation is hurting most consumers, even though we've got stock markets at all-time highs. Most Americans say their financial well-being is slipping, and even some consumers have given up on saving for the American dream and getting a home, and instead are just spending money with no plans on saving it. And just looking at actual increases of 3 of the most popular fast food restaurants in America, and the change of price from the end of 2019, just prior to COVID, to where we're at now. Looking at McDonald's, McChicken's gone up 201%. Looking at Taco Bell, beefy 5-layer burrito up 118%, and Chick-fil-A, 8 nuggets gone up 96%. The average price increase from McDonald's 141%, Taco Bell 57%, Chick-fil-A 80%. And just shows you some really popular businesses. And I'm sure many of you have noticed that with products you regularly purchase, not just food, but maybe stuff from your local hardware shop, other things like that, gone up a lot more than 20-30% from 2019, which is what official government reported numbers have said prices have gone up. In reality, for a lot of things have gone up a lot more. And so the Fed's got to be worried about the price action in commodities and how much that correlates with inflation and the current divergence we've got with reported CPI numbers, which they can play around with a lot remove things, add things, revise things, take different data sources for their inputs. Clearly got commodities pointing back up now, whilst we've got the Fed saying inflation's on its way back down to 2%. And we've also got the price to move those commodities around starting to rip back up as well. Just looking at the price for freight rates coming out of Shanghai, the most busy shipping port in the world, with China labelled as the world's factory. And with their demand picking back up, along with commodity prices and shipping rates, again, it's going to be a miracle if we get inflation under 2% this year. That is, if it's reported correctly. Helping the picture is a soft oil price. Biden administration having been effective in a series of announcements and policies this year to keep a lid on oil and gas prices. And we saw that again today with the announcement from them. They're going to release 1 million barrels of gas to reduce prices at the pump ahead of the busy driving weekend of July the 4th. And it's a bit of a controversial move because normally this reserve is used as a strategic backup in case of extreme weather, storms, wars. However, we've seen this administration also release a lot of oil from the Strategic Petroleum Reserve, taking it down to 41-year lows as well. And the lower that goes, the more exposed and vulnerable the states could be in the event of a major weather event or geopolitical event as well. So it's a little bit of a gamble from Biden. However, it should definitely help his chances of getting re-elected if he can get the price of gas and oil going down into November. And we've now got a number of commodities across the complex ripping higher. Saw that again today with uranium trading firm on rising demand and a Russian import ban. As like oil, they're one of the top providers of uranium in the world, and the US is seeking to increase the sanctions on Russia and freeze Russian assets, keep the pressure on Putin, and that's likely going to incentivize China to continue deleveraging from the US dollar reserve system. And just like uranium, we've got a lot of commodity markets in supply deficit now and going into the future, thanks to a decade plus of underinvestment and the years-long lag it takes from investment to set up a mine and start producing. You can see that here with silver. Forecast to go into the second highest deficit on record between supply and demand. We've also got important metals like copper used in electric vehicles and artificial intelligence, surging to new highs thanks to the commodity-hungry country of China, which actually consumes more than half of the world's copper demand. And relative to equities, commodities are still near record lows in terms of valuation and price performance over the last decade and a half, and that's showing up in investors' allocations to the most popular commodity, gold. 71% of investment advisors have less than 1% of their portfolio allocated to gold. And if this money here moves over to this column or this column here, that's going to power a bull market in gold and other commodities for years to come. And there's a look at gold today, sitting above $2,400 an ounce. Silver setting near highs. Crude pulling back to $78 a barrel. There's a look at the uranium fund, trading up to yearly highs. Wheat breaking out again. Orange juice still running. And a big bounce back for coffee today. Moving over to crypto, we've got Ethereum surging over the last 2 days as we've got speculation. The SEC is going to flip after apparently they may have got a call from the White House saying they can go ahead and approve these Ethereum ETF applications. And this has changed a lot in the last couple of weeks, with the industry now saying they're looking likely to go ahead, and we'll get to hear from this over the next couple of days. From it previously looking almost certain they were poised to reject applications from big fund managers, SEC hasn't been responding to a request for comment, and they face a deadline on Thursday to approve or reject a spot ETF that holds Ether. With some saying the Biden administration, who had previously been tough on crypto, is now softening their stance in tandem with the SEC, with some speculating that's in response to the Trump campaign, now accepting crypto donations, and Trump too, over the last couple of weeks, becoming more embracing of cryptocurrency and Bitcoin, after him too, in his first presidency, pushed back on crypto, the whole idea of it. He's come around to it, potentially as a way to differentiate himself from the Biden administration, as a lot of people are in support of cryptocurrency. And this is on the back of Trump leading the way in fundraising for his campaign, reportedly raising $76 million in April, an increase of $10 million from their March fundraising, and $25 million more than the $51 million Biden raised last month. And we'll get to hear more about this tomorrow, as the House of Representatives is expected to vote on the Financial Innovation and Technology for the 21st Century Act, legislation that would clarify oversight boundaries of the crypto industry and grant the Commodity Futures Trading Commission primary jurisdiction over the industry at the expense of SEC. So it looks like the SEC could be pushed aside, and the messy battle they've been having with the crypto industry for years now. And so I say Gary Gensler has probably just had enough of this and may just sign off on these Ethereum ETFs, as it looks like both sides of the government, now with Biden not wanting to let Trump take the lead on this issue and separate himself. If we've got both sides of the government wanting to get this done, then it very well could look like the US government embraces the cryptocurrency industry, something that didn't look like it was going to happen just a couple of months ago, especially with talk of the central bank digital coins. However, that's markets for you. Not everything is clear cut. Things do get flipped on their heads, and maybe this could just ignite a monster rally in Ethereum, if the SEC does go ahead and improve these new ETFs, then like I said, where does it stop? Maybe we could get more crypto ETFs on the market. Dogecoin, some other meme coins. And there's a look at Ethereum today. Ripping up on strong volume here. Still a bit off all-time highs. 4,800 we reached in late 21, but we're definitely in a bull market here. And Bitcoin, even more so. Just a bit below all-time highs we reached in March. Currently sitting over $70,000 a coin. And unfortunately, looks like I got out a bit too early of that spread. I'd mentioned to you guys back in March, going into early April, long the grayscale Ethereum Trust, which had been trading at a deep discount to NAV, versus short the underlying Ethereum. It was about a week and a half ago. We were getting news and reports that the SEC was going to reject it and block it, so I thought this trade was no longer good. However, seemingly out of nowhere, it appears they're going ahead now, and that's why this spread has had a massive jump here today, off the lows just a few weeks ago. However, that's trading. Can't win them all. It's what makes it so challenging and interesting, and why we just move on to the next trade. Relatively quiet week on the economic calendar. We've got Canada's inflation rate. Headline year over year coming in line as expected. Core inflation rate actually beating 1.6%. Just a bunch of Fed speakers this week from the States. Tomorrow, not much out. Just got Nvidia earnings after close. Then Thursday, the biggest economic print of the week. Manufacturing and services. Purchasing Managers Index, PMIs. Fed Fund futures pretty much pricing in 2/3 chance. Going to cut in September and maybe another cut in December. Fear Greed Index still in the greed zone at 63. And corporate insiders selling to buying pretty much around normal levels here. Got short-term breadth pulling back here, but still close to 80% of stocks above their long-term average. There's a 2-year sitting at 483 and a 10-year at 440. Another pullback in Chinese securities with a bit of a dip there for Tiger Brokers today. May come back down and touch the 50-day. Clean energy still holding up, and the spread between value and growth stocks turning back down. Losing sector today was transports, down almost 2%, and winning sector, utilities, up almost 1%. All factors finished higher today, led by growth. As a look at cannabis, just trying to find some support above $9 a unit. There's Nvidia, pretty much trading flat now after hours, going into earnings tomorrow. That appears to be coiling up on low volume as well. And I'd say the chances are we could be seen north of $1,000 a share tomorrow afternoon in post-market trading. Make sure you come back to the Click Capital channel and I'll give you a live breakdown of everything from the earnings report, along with the market's reaction and where I think it means we could go next. Good rip today in Tesla, up over 6%. Got news PepsiCo is going to add Tesla and Ford vehicles to their California electric powered fleet. Another strong day for my favorite clean energy utility, NextEra Energy. Having a really good year so far. Still got some of the discretionary retailers trading weak. There's Best Buy down 1.6%. Target coming off a little bit here too. And the financials having a pretty good day here with the big banks trading up over 2%. Alright guys, there we have it for this Tuesday session. Market's still on this parabolic rip since the first of this month. Sitting pretty much at all-time highs here. Everything's pointing for this market to go higher. And Nvidia earnings tomorrow may just do that. Otherwise, it would be quite a big upset if their numbers or guidance came in anything less than amazing. Market's pretty much expecting them to knock it out of the park again, and there's no reason why we can't keep grinding higher in this low volume and low volatility environment. Thanks very much for tuning in to my daily market review, and I hope to see you back here again tomorrow night for Nvidia earnings. Cheers guys.